Motor finance, though, Mark, the issues about commissions, historic commissions being charged to customers, rumble on. Why don't we start by talking about what the FCA outlined in its redress scheme the other week?
Well, all of this relates back really to a legal decision midway through this year, which gave the FCA the legal footing that it did to act, and that was under the Consumer Credit Act of 1974. They've got behind in there. They've attempted to put together a scheme that's essentially fair for actually the lenders themselves, but also for the people that have been missold under the commission basis. The scheme that they've designed is going to be evidence-based and time limited as well, and proportionate. And I think those last two issues as well are linked in a way to some of the problems that we had in the past with PPI. So they've published details which will cover around about 14 million unfair deals, and they say it's going to average around about £700 per deal as well. The spread is actually slightly larger than the time frame rather is slightly larger than was anticipated initially. So lenders themselves are going to have to try and find the details between April 2007 up to November of last year as well. So the overall figure for compensation that the FCA has put forward is about £9.7 billion. That rises to around about 11 once you've got legal costs into the mix as well. That's about half of what the early estimates would have been. But they just came to the view that the mis-selling applied to around about half of the loans, or the relevant loans over that period as well. So it's going to present a few operational difficulties for the lenders themselves, and there's evidentiary issues as well. Again, looking back at the previous mis-selling scandals as well, I think the FCA has been pretty keen to avoid some of those pitfalls there. Although, given the fact it stretches back so long, bearing in mind what's gone before, they might struggle a little bit as well, because the lenders will have to demonstrate adequate disclosure, or that they offered the lowest rate, or that the consumer was financially aware of the potential pitfalls and what was happening with the commission. So
Yeah.
I think they've tried to balance it basically.
Yeah, and from the consumer point of view, I believe the stipulations are that if they had a discretionary agreement where dealership kept extra interest that customers paid on a loan, or had a commission worth over a third of the total cost of credit, or they were tied in to an exclusive arrangement with the dealer and lender, and if none of these things, or if any of these things weren't duly disclosed, that's when compensation may be applicable. I mean, this whole thing has rumbled on for quite some time. The government, Rachel Reeves, tried to get involved earlier this year with limited success. The initial response to the FCA scheme was relatively positive from the market, wasn't it? Because that 11 billion total figure was seen as lower than, I think this summer, the FCA said its range would be 9 billion to 18 billion. So investors thought, oh, great. However, as we flagged last week, and as has proven to be the case, some analysts and some people were nonetheless a bit skeptical that the news was as good for banks as they first thought, partly because of the amount of time, as you said, Mark, for which this redress scheme covers. It goes all the way back to 2007. Some analysts thought that therefore provisions would have to be increased. And that is what we saw last week to start with. I think it was last Thursday. Lloyds and Close Brothers saw quite big share price falls, certainly Close Brothers, which is a smaller business, when they said they were going to have to increase provisions, which they've now done. Can you say what the detail of that is specifically?
Yeah, for those particular entities as well, Lloyds added an additional 800 million for the compensation claims. That brings their total amount to just under £2 billion. But it's worth bearing in mind that the PPI scandal cost Lloyds about 22 billion last time around. So that gives you some idea of the scale involved here. Close Brothers nearly doubled its provision, taking it up to 300 million from an earlier, the original provision of 165 million. But the criteria that you mentioned before is quite interesting as well, because it may be the case that those related legal fees might be understated or underestimated at this point because of the sheer logistics of the evidentiary problems that we mentioned earlier as well. That's going to provide a bit of a stumbling block, I think, for the likes of Lloyds and Close Brothers.
And then they both said they will challenge aspects of the scheme as well. So, well, this clearly isn't the final word either way, but it might not even be the final shape of the scheme if they're successful.
Yeah, I think they were they they took exception to the FCA analysis about how many borrowers were affected by it or were unaware of the underlying commission basis as well. So, according to Close Brothers, they said that they didn't believe the redress methodology proposed by the FCA. According to them, it didn't reflect actual customer loss or and they questioned whether it would in fact engender a proportionate outcome there as well. Lloyds were also critical of the FCA, saying that the scheme again was not proportional, or that it didn't ensure customers were rightly compensated. It didn't reflect the actual loss of borrowers as well. So I don't know. I think it was a case even like BMW have been, because I think they're on the hook for about 200 million or something, and they've been lobbying for a meeting with Rachel Reeves. And presumably there's other smaller lenders, industry. I think the banks will only account for about half of the monies involved all up. The rest are smaller lenders, industry arrangements as well.
And as you said, car makers with their financing arms, Renault as well, I think, is on the hook. Rachel Reeves, just to go back to that, at the start of the year, did try to push for a softer settlement, a more pro-industry settlement, which didn't really pan out in terms of the Supreme Court decision, which we won't go into right now, but it'll be interesting to see if that is brought to bear FCA in line with these representations. One company we could mention, another company, S&U, which at the beginning was caught up in all this, certainly share price-wise, but is relatively insulated now, partly because it hasn't made it didn't have the discretionary commission agreements, which are the focus of this scheme. So it may be worth just flagging that as well. There wasn't really much share price reaction, as you'd expect in that context.
Yeah, they've taken a more prudential line right from the get-go by the looks of it. It's their Advantage division, which covers their motor financing as well. And, they've been performing pretty well as well. The profitability was up by about 15% the last time that we covered the company. And they are definitely better shielded than most, but it doesn't appear to have been reflected in their share price up to now, because they're still trading at a decent discount to net assets as well. But maybe when all the dust settles on this issue as well, people will take a second look at them. The point about the FCA and Rachel Reeves is good in a way, because it shows, it does point to the independence of the group too, which is to be welcomed.
Do we think, just to wrap up, we've spoken about PPI, that is the obvious comparison in some ways, the last big mis-selling scandal of this nature, or a similar nature, should we say. Do we think this could end up rumbling on for a long time, as with PPI? The FCA, the regulator, again, is trying to take some steps to, if not prevent the situation dragging on, as I've just described, then at least to try and prevent some of the behaviors we saw happening with PPI, where you got a whole load of third-party people getting involved and people seeking compensation through routes that weren't necessarily the best way for them to get compensation.
Yeah, I think that's already in evidence, though. It has been for several months now. I mean, any browse through electronic media and you're being assailed with offers if you've been missold finance on this basis, and it's very difficult to do away with that incentive too. I remember, and the last time as well, that banks were taking provision after provision after provision as well because they had no idea of the scale of the issue itself. And I remember what was slightly surprising and somewhat disturbing last time around was the paucity of their record keeping as in addition. And it's to be hoped that there's a bit better paper trail where issue is concerned. It'd be ridiculous if it wasn't in line with what's gone before. But I don't know. My instinct is it won't be comparable to PPI, but I do think that it will drag on for a bit longer than the FCA might hope for.
Mm. Well, it has begun a campaign to stop people using third-party compensation routes or third-party companies to file claims, which was what we saw with PPI. We'll see how effective that is, but we'll also keep an eye, of course, on the provisions, as will the market.